today seems to be a scary day if you are an investor with Chinese equity. Let's take a closer look in today's episode. We can see Tencent is down roughly 14%, we have Alibaba down roughly 16.7%, and we have JD down roughly 19.3%. So in today's episode, what I want to do, take a closer look at what happened and maybe take a closer look at some learning opportunities that us as investors can take from it. So let's get started.
I do want to thank The Motley Fool for sponsoring this video, and make sure to check out fool.com/Jose to get the top 10 stocks to buy right now.
So over the past 48 hours, we received a lot of news coming out of China. First, Chinese President Xi paved the way for a third term as leader and also packed the standing committee with loyalists. So investors are fearful of two things. First, by packing the committee with loyalists, it means that Xi might not get any pushbacks for any type of policies he might try to implement, which might not be the best thing for investors. The second thing is they are fearful that there might be an increase in kind of regulations and kind of strictness, and that can overall hamper the growth for tech giants like Alibaba, like JD, and some other big players that we know. The second piece of article that came out is China did release their GDP numbers. The official release was 3.9% year-on-year growth for the third quarter, bringing year-to-date growth to 3%. This is still well below the official target of around 5.5%. There are many investors that are kind of worried or keeping a closer eye on this number, especially since the data was originally set for release on October 18th, but was delayed late with no explanation, just coming out October 23rd. So as we continue to see stock prices going down, is it always bad to invest in the Chinese market or any form of international market at that? And if you are enjoying the episode so far, make sure to hit me with a thumbs up as it does help me grow my overall audience. If you want to support a little bit more, make sure to subscribe using my link at fool.com/Jose. I do believe that's up to every investor, but every investor should know risk and reward. When risk is high, obviously the reward could be high as well. When risk is low, you tend to see a lower side in the reward. And with China, the risk seems to be pretty high, as many investors kind of do concerns about the political aspect in the region, geopolitical issues, and so many other tensions happening worldwide that make China a higher risk investment. I mean, here's a prime example. If we take a closer look at forward PE ratios for a big Chinese giant like Alibaba and also a huge United States giant like Microsoft, we can see Alibaba's forward PE ratio is super cheap. The reason being is there's numerous risks, like we're seeing right now, that investors are not willing to pay a high multiple for this company due to its risk. Compared to a company like Microsoft. Microsoft is a tech giant here in the United States where they believe it might be less susceptible to certain risk, which allows investors to pay a higher price point for it and kind of increasing the overall multiple. I mean, we see it with growth stock investors like myself all the time. I understand that growth stocks have a higher risk and that some of them might go bankrupt, but I do believe that there is a chance that some of them could be great winners and provide great returns. I mean, a prime example is Amazon, for example. This is a company that really didn't start to be profitable until 2016. Even if we take a closer look since its IPO in 1997, that the stock has returned 132,000%. But even since late 2009, the company still has returned over 1,600% to investors. And again, like I mentioned, Amazon was not completely profitable until 2016, and even now it still trades at a higher multiple. We can see when it was trading at a higher multiple of 2016, the risk was a lot higher, but obviously, as we can see from the stock market chart, the rewards also provided with that risk. It doesn't necessarily mean it's always going to work that way. And that's why I believe asset allocation is important. To me, some of the biggest things as investors is one, understanding risk and reward, and two, allocating properly based on that risk and reward. Obviously, if you feel companies may be a little bit more riskful, you won't invest as much. Maybe keep it at 2, keep it at 3, keep it at 4%. If you want to invest into, for example, the Chinese market, maybe 10% of your overall equity is more than enough for you because you understand the risk. Then there are other investors that do not want to take that risk and would prefer 0% in the Chinese market. I do believe in that scenario, both investors are right as long as they understand the risk and reward. Obviously, there could be time frames like now when the investor that had no investment in China is right, but there could be a point in time when the investor that had 10% in China when there was high risk and reward would also be right. And especially for new investors that might be sad that they invested in Chinese stocks, I do want to say take the opportunity to learn. Maybe you learned a few things. One, that hey, you invested too much in a market that you thought was a little bit too risky, so now you know to allocate a little bit lower. Maybe you learned that you were right and that you understood that there was risk in this market you weren't willing to take, so you didn't invest in the market and you learned something good. Or you learned that hey, your proper risk allocation, you only allocated 3, 4, 5% of your portfolio into the Chinese market, so even with this downfall, it's not something you're gonna stress about. So in the market, we all make mistakes, and that's gonna continue to happen. No one's gonna hit numerous home runs. The most important thing from here on is to learn from these mistakes and learn how to use what we learned to make better investments in the future. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.